Good morning, everyone, and welcome to the Daily Hunt for Multibaggers. It's Saturday, October 25th, 2025, and we're diving deep into all the market buzz and AI-generated insights we gathered from yesterday, Friday, October 24th.
That's right, Ethan. Our systems have been busy processing a significant volume of social media discussions. We saw quite a few posts covering a broad range of stocks. And the sentiment is pretty mixed out there, presenting both some intriguing opportunities and, as always, some serious cautionary tales.
Definitely, Brooke. It looks like the market is, well, it's never dull, is it? Let's jump right into some of these individual companies that caught our attention. First up, we've got Cipher Mining Inc., or CIFR. Now, one user was extremely bullish, saying they're full port on CIFR and have been in and out for years, still holding. They clearly have a strong long-term conviction, and we've seen some pretty significant price appreciation from its 52-week low recently. There's even talk of a Wall Street firm, Jane Street, taking a significant stake, which could signal some institutional confidence.
Ethan, while that user's conviction is certainly, shall we say, enthusiastic, the KPIs tell a rather starkly different story. We're looking at severely poor financial health here. A net profit margin of negative 96.95% and negative EPS of negative 0.45, that's deeply unprofitable. The debt-to-equity ratio is an eye-watering 25.275, which is further exacerbated by news of them raising billions in junk bonds. This stock also has a beta of 2.886, meaning it's highly volatile and, frankly, directly tied to the highly unpredictable Bitcoin market.
Wow, those numbers are certainly sobering. We've actually consistently rated CIFR as stay away in past episodes, and it seems those fundamental concerns haven't really improved.
Precisely. Considering those critical financial weaknesses, our AI-generated insight for CIFR remains a stay away. The risk of capital loss is simply too high for new entry.
All right, let's pivot to a heavy hitter, NVIDIA Corporation, NVDA. Users are calling it the benchmark for superior classical computational power, and one comment even suggested that NVDA's focus away from unproven quantum tech is a strength. We're seeing it mentioned as working with legitimate advanced tech sectors too. And, just look at their KPIs. Revenue growth at 0.556, net profit margin at 0.524, and an ROE over 1.09. Their stock is near its 52-week high, reflecting that amazing momentum.
Ethan, you're right. The financial health of NVIDIA is undeniably robust. Those profit margins and revenue growth are exceptional, validating its market dominance. However, the price-to-earnings ratio of 53.21 and price-to-book of 45.28 are quite high. While it's a testament to market confidence, it also signals that significant growth expectations are already factored into the current share price. It's a premium price, but the fundamentals are solid.
This rating is an affirmation from our previous buy rating. Given that, I think our AI-generated insight for NVDA is a clear buy. The strong fundamentals and market leadership are compelling. And next up, International Business Machines, IBM. The social chatter here is actually quite interesting. While there's a lot of skepticism around smaller quantum pure plays, users often mention IBM as a safer, more stable alternative for quantum exposure, noting their vast R&D budgets and ability to sustain long-term projects. They have a respectable dividend yield too, at 2.19%, and the stock is trading near its 52-week high.
That's a fair point, Ethan, about IBM's long-term play in quantum. However, the current valuation has me raising an eyebrow. A P/E ratio of 36.6, with the stock so close to its 52-week high, suggests that much of that long-term optimism is already priced in. And crucially, their debt-to-equity ratio is extremely high at 237.831. While a large company can manage more debt, it still introduces a significant layer of financial risk, particularly for new investors entering at this valuation. We had a stay away rating recently for IBM, and it seems those underlying issues persist.
I hear you, Brooke. For IBM, even with the quantum R&D, our analysis suggests a stay away. The current valuation and high debt are too significant to ignore for new entries. Let's talk about Churchill Capital Corp. X, CCX. This one had a fascinating discussion. Despite a bearish original post about quantum, a lot of comments really differentiated CCX, talking about its quantum sensing and real revenue, DoD contracts, and tech literally deployed in the field today. Users believe it's far more legitimate than other quantum plays, and news indicates they're going public via a $1.8 billion SPAC deal. Those are certainly strong points for community optimism, Ethan. However, the KPIs paint a very different and frankly alarming picture. Its price-to-earnings ratio is an astronomical 512.25. That screams massive overvaluation. But the biggest red flag to me is a profoundly negative price-to-book amount of negative 5122.5, indicating negative shareholder equity. This means their liabilities far outweigh their assets. Combine that with net profit and operating margins of 0%, meaning they're not generating profits from operations despite claims of real revenue, and you have a company in severe financial distress, in my opinion. We've consistently flagged CCX as a stay away. I agree, Brooke. For CCX, despite the user enthusiasm for its technology, the financial fundamentals indicate a stay away. The risk is just too substantial. Okay, moving on, we have Rigetti Computing, RGT. The original post was highly critical of the quantum sector, explicitly calling RGT out for having no intrinsic value and no revenue.
And the KPIs, well, they really back that up, Ethan. RGT has negative revenue growth at negative 0.416, zero net profit margin, and negative EPS of negative 0.88. Their operating margin is also deeply negative. The price-to-book ratio is an exceptionally high 22.7, suggesting immense overvaluation compared to assets. And with a beta of 1.608, it's highly volatile. This isn't just a speculative gamble, it's a company with significant financial distress. We've had a consistent stay-away rating here.
It sounds like the data hasn't shifted much. For RGT, it's a clear stay away. Now, let's discuss Energy Transfer LP, ET. It came up a few times, mainly because of generic news post titles, but when we look at ET itself, it offers a really attractive dividend yield of 7.83%, which is huge for income investors. News reports are even calling it a screaming deal and an ultra-high yield dividend stock. It also has a low beta of 0.759, suggesting less volatility than the overall market.
Ethan, I appreciate the appeal of that dividend, especially in this market. But we have to look deeper. ET's debt-to-equity ratio is an exceptionally high 134.278. That's a massive amount of leverage. And, crucially, their revenue growth is negative at negative 0.072. While some MLPs carry higher debt, negative revenue growth combined with such high leverage raises serious concerns about the sustainability of that dividend and the company's long-term financial health. The current price is also closer to its 52-week low. This is a first-time rating for ET from us.
You've definitely highlighted some significant risks there, Brooke. For ET, given the high debt and negative revenue growth, our AI-generated insight is a stay away. All right, let's talk about AMC Entertainment Holdings, AMC. The sentiment from the social post was pretty dire, talking about bearish pin bars and a downtrend channel. That sentiment is absolutely reflected in the KPIs, Ethan. AMC is deeply unprofitable, with a net profit margin of negative 0.073 and negative EPS of negative 0.87. But the real red flag here is a negative price-to-book ratio of negative 0.675, indicating that the company's liabilities exceed its assets. It's trading very close to its 52-week low, reinforcing that strong downtrend. There's just no fundamental value here. Our previous rating was stay away.
Absolutely, Brooke. For AMC, our analysis firmly points to a stay away.
Let's move to Toyota Motor Corporation, TM. Our social media data was unrelated to TM this time, but looking at its KPIs, it boasts a low PE ratio of 9.53 and a solid dividend yield of 3.39%, which is great for value and income investors. It's trading near its 52-week high, showing momentum, and has an incredibly low beta of 0.209, making it super stable. Analysts are largely bullish too, and they're investing in advanced tech like charging and 5G. This is a first-time rating for TM.
While the stability and dividend are attractive, Ethan, we can't ignore the debt-to-equity ratio of 103.922. That's quite high, and the revenue growth is modest at 3.5. The extremely low price-to-book of 0.074 also warrants a closer look, as it can sometimes signal accounting issues or deeply undervalued assets, but it's unusual for such a strong company. However, the PE and dividend are compelling for value-oriented investors, and its low beta does offer significant risk mitigation.
Given its strong valuation, stability, and income potential, despite the debt, for TM, our AI-generated insight is a buy. Next up, IREN Limited, IREN. This one had some very enthusiastic community sentiment, with users projecting triple digits by end of year and saying it's just getting warmed up. There's a lot of buzz about its pivot to AI, and B. Riley even raised its price target significantly to $74, maintaining a buy rating.
Ethan, the community and analyst optimism for IREN are certainly pronounced, but the KPIs signal significant caution. We're looking at an extremely high price-to-earnings ratio of 142.95 and a price-to-book of 8.93, indicating a massively stretched valuation where future growth is already heavily priced in. And the beta is an alarming 4.199, meaning extreme volatility. While the AI pivot sounds promising, this stock is exceptionally risky at these levels. We've had mixed ratings on IREN in the past, including buy and cautious buy, but most recently it was stay away.
It sounds like the current valuation is a big hurdle. For IREN, despite the bullish community, our analysis is a stay away. All right, let's move to RTX Corporation, RTX. The social media post was very bullish, highlighting their drone defense systems and a $5 billion fucking contract from the Army. Users see it as a long-run positive. The stock is near its 52-week high, and JP Morgan just raised their price target to $195. This is a new one for our ratings.
Ethan, this is an interesting one. The strategic market position with those large government contracts is indeed a strong point for future revenue. We see positive revenue growth at 0.119 and a healthy net profit margin of 0.076. While the PE of 36.60 is somewhat high, it reflects the market's expectation for that future growth from the contracts. The low beta of 0.648 also suggests relative stability for a defense stock.
With those substantial contracts and solid fundamentals, for RTX, our AI-generated insight is a buy. Switching gears to Advanced Micro Devices, AMD. Users were reporting significant gains, with one saying it feels like a loss only because of a missed options opportunity, implying the stock surged far beyond expectations. It's currently trading at a record high, near its 52-week peak. Revenue growth is robust at 0.317, and news confirms new all-time highs.
That rapid appreciation is certainly impressive, Ethan. However, the valuation metrics are extremely elevated. The price-to-earnings ratio is a staggering 151.45, suggesting that an enormous amount of future growth is already baked into the current price. Entering at an all-time high also limits immediate upside and increases the risk of a significant pullback. Furthermore, a debt-to-equity ratio of 6.513 is quite high, adding another layer of financial risk. Our last rating for AMD was stay away.
Those are serious points to consider. For AMD, despite the recent run-up, our analysis for new entry is a stay away. Next up, Open Door Technologies, OPEN. The community is overwhelmingly bullish here, talking about 12K gains and expectations of a run-up to earnings. Users are looking at 15 to 20 targets, citing rate cuts and tokenization efforts as catalysts. The stock has come a long way from its 52-week low.
Ethan, while the user sentiment is high-flying, the company's financial performance brings us back to earth. Open is deeply unprofitable, with a net profit margin of negative 0.05 and negative EPS of negative 0.43. Their operating margin is also negative. The revenue growth is a modest 3.7, which doesn't really justify that kind of speculative momentum. And the debt-to-equity ratio is an astronomical 346.117. That level of leverage, coupled with unprofitability and a high price-to-book of 9.267, makes it an incredibly high-risk proposition. We've consistently rated Open as stay away.
Unfortunately, the fundamentals are just too weak. For OPEN, our AI-generated insight is a stay away. And finally, let's talk about Amazon.com AMZ. We saw a ton of bullish sentiment, with users YOLOing into it, anticipating strong earnings, and setting ambitious price targets from $230 to $260. They see it as a solid blue chip that's undervalued. And the KPIs are fantastic. Revenue growth at 0.13, net profit margin over 10, and a superb ROE of almost 25. Analysts are also very positive, with Wedbush expecting strong Q3. We had a cautious buy last time, but this looks like an upgrade to me.
Amazon's financial performance is indeed impressive, Ethan. Those strong growth rates, healthy profit margins, and excellent return on equity are undeniable. While the PE of 36.60 and PB are on the higher side, they are justified for a company with such consistent growth and market dominance. The stock is near its 52-week high, but the overall strength and positive outlook from analysts support its continued appreciation. This is a solid upgrade.
All right then, for AMZ, we're confidently saying buy. And let's not forget Alphabet Inc., GOOG. The Goog Leap Mafia is out in full force. Users are incredibly bullish, calling it free real estate and the highest net income company on the planet. They're setting targets of 300 to 350 and committing to long-term holds. And boy, do the KPIs back that up. Revenue growth at 0.13, an incredible net profit margin of 3.11, and ROE of 3.34. Plus, they just achieved a first-ever quantum advantage. This was a buy previously, and it seems to be holding strong.
Ethan, you're absolutely right. Alphabet's fundamentals are simply exceptional. Those profit margins and returns on equity demonstrate incredible operational efficiency and value creation. The PE ratio of 27.0 is quite reasonable for a tech giant with this level of growth and innovation. While it's near its 52-week high, the analyst price target increases and the ongoing technological advancements like quantum advantage provide strong catalysts for continued growth. No red flags here that overweigh its fundamental strengths.
For GOOG, it's another strong buy recommendation. 3. Today's candidates for deeper analysis. Investigate as buy. NVIDIA Corporation, NVDA, Toyota Motor Corporation, TM, RTX Corporation, RTX, Amazon.com, AMZ, and Alphabet Inc., GOOG. Investigate as cautious buy. None. Investigate as speculative gamble. IREN Limited, IREN.
Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for joining us on this edition of The Daily Hunt for Multibaggers.
We'll catch you next time.